The U.S. has been stripped of its top-tier credit status by Fitch Ratings, the credit agency downgrading to the U.S. to AA+ from AAA. Now, the last time this happened was 2011. Different agencies started it then. Yahoo Finance's Blikre joins us now. Jared, I was covering this then. You were trading it in 2011. So talk to us about what it looked like then.
Traders were really skittish back then. Over the summer, Greek debt and periphery debt in general, those yields and spreads had exploded such that their debt was a lot more expensive. And then the problems come home to roost in the U.S., or so it seems, because the S&P, they downgraded U.S. debt at the time. Excuse me here. I want to show you the charts as they existed at the time. This goes all the way back to 2007. So this orange line is the S&P 500, and this dotted line here coincides with that August 5th date that S&P downgraded the U.S. debt. Way back in 2011, the S&P was trading at about 1,200 and the 10-year was trading at about 2.5%. That would be right here. What happened from there? Well, stocks actually sank a little bit and they fell into what the media would not call a bear market, but it was 19.5% down from close to close, so might as well have been one. Markets were very difficult to trade, but a few things happened that stabilized the markets. We had Jackson Hole, that was in late August. Bernanke came, tried to reassure the markets the way he had the year before. We were not currently doing QE at the time, so that was kind of a dead issue. But the Fed would go on in October and November to institute Operation Twist, and that was where they would buy longer dated U.S. Treasury debt and sell the shorter debt. All in all, we did see Treasury yields fall, and as Julie was pointing out earlier in the hour, that was kind of a non-intuitive move. But when you consider the Fed's reaction and how they were buying and supporting the Treasury market, that might make sense, because as yields go down, that's indicative of buying interest. All in all, the market found its footing and was back at record highs in 2013. Right now, today, we are just a few percentage points shy of record highs. I'm going to show you the S&P 500. This is actually a much shorter time frame than what we were just seeing. We're not even a year out from the lows that we saw last year, but in 2011, we were a couple years back from the lows. Those lows came in early 2009. So very much a different situation. We're seeing stocks under pressure today. I'm going to look at a couple different markets. We're seeing yields up today. So that's actually that's actually the opposite of what happened before. And this is something that I really want to keep an eye on. This is the 10-year T-note yield over the last 2 years. This is a 4% level. This is the big one that we're watching right now. But guess what? 5% is way up here. And when you consider that this may be just a basing action and priming for the market to head higher, that technically is actually probably the highest probability scenario for me. So if 10 years shoot up, the 10-year shoots up even farther, that's going to present a lot more hiccups for the market than downgrading the U.S. debt, because I'm not just seeing that in the market's reaction just yet. Another thing that happened back then was gold. I'm not seeing gold prices move today. Let's take a look at that. Gold was actually coincidentally near the highs of the time, pretty close to the all-time highs. Way back in 2011, it would shoot up to those highs, and then it would slowly sink to other levels. But right now, gold is kind of flagging up here. You could call that a bullish consolidation as well. But we're just not seeing. Here's an intraday look at the gold market. Just not seeing too much action that would say, yes, there's a huge problem in the markets.
Good stuff there. We appreciate your deep dive as usual, Professor Jared.
Thanks, Jared.